Just to kind of give you a brief overview of, people usually want to know for exit how much money their company is worth, and so there's certain dynamics dealing with EBITDA. I'm glad when I started in this industry, people always said, "How much per gallon is my company worth?" The industry has changed so much over the years. It doesn't work that way. It works on a return on investment. And the thing that people use is EBITDA, earnings before interest, taxes, depreciation, amortization, cash flow, which is basically what you sold your fuel and services for minus the parts cost is gross profit, less your operating expenses. Now you have to normalize that for things like the weather. You have to adjust it for owner expenses, that wouldn't happen under a new ownership. And then the buyer is really the one who's valuing your business. So you have to look at, what the buyer looks at their projected earnings, what attrition, where they think that's gonna be, or growth or margin growth. New for this year, the normalization, things are a little odd with COVID, and we're going to talk a little bit about that today also, because there's some things that have changed in this particular year. So I just wanted to cover a little bit of valuation first. I have a saying, 10-5-3-1 exit. So what this means is for owners out there, I think everybody, eventually looks for an exit strategy. I hit 60 this year, and I know I've thought about it. So if you got 10 years left, it's a very different exit strategy than 5-3-1. So I want to talk a little bit about that. One of the important things are to have consistent financial information, particularly on your P&Ls, your income statement. That's what most people will look at. Paying down debt. If you're getting ready to exit, you really want to focus on paying down as much debt as you can. Investment in hard assets is interesting. People that call us and say, "I'm ready to put my business on the market, and I was going to buy a new truck." I usually say, why don't you hold off on that? You're not going to get your money back on a new vehicle if you're getting ready to exit. With that said, if you're 5 or 10 years out, not only might you need a new vehicle, but it might lower your operating costs to do that. And with depreciation, which we'll talk about, that might be a really good thing for you. Also, investing in technology. Sometimes that cost benefit, you can have a payoff in a year or two, maybe even 3. So yeah, those are the kind of things we highly recommend. On the propane side, tank monitors are just a great way to reduce your operating costs, particularly with driver shortages going on. So we highly recommend that. Again, not if you're out next year, but if you're 3, 5, 10 years, yes. Most companies, I put push margins. I usually say a little bit beyond your comfort level. Most companies are worth more than they charge. So, keep an eye on it. If you find customers are leaving you because of price, if you have a high percentage of will call business, be a little careful. Manage your expenses line by line. The one that always pops out at me is insurance costs. People shop insurance and it goes down 25%. And then over the next 3 years, the insurance company tends to get it back. But take a look at every one of your expense line items, because that will all add to EBITDA if you're real tight on that. Making the owner dispensable. If everything revolves around the owner, buyers are going to be very cautious of that. So you want to try to, make it that the company, even if you have an owner with a strong personality, do you have? One question I ask owners many times is, if you took off for a month, if you won an around the world trip and you're going to be gone for several months, who would be running your business? To try to identify if there's someone there to do that. So, try to have that in place. Track the expenses that would go away, owner vehicles, cell phones, internet. at your home, those type things. You track them all because those are all considered add backs. That's part of the adjustments that we look at when we value a business. Seeking professional advice, accountants, attorneys, advisors, M&A advisors, of course, I put a plug in for our industry. We always pay our own way on a sale process, but even before that, getting a really good accountant. We've had situations where accountants, have not been as good at organizing things, and we've been told things like, well, we have accelerated depreciation, so it doesn't matter whether we expense it or depreciate it. Well, it might not matter for tax purposes, but it certainly matters for having your paperwork in order when you have someone looking at your business, or even just getting a valuation, whether it's stock gifting or whatever. Okay. This is a list of value drivers. People ask, why is companies are valued on a multiple of EBITDA, a multiple of operating income? What makes up that multiple? Why is one company sell at 2.5 times and one sell at 6 times or 8 times? So these are the items, the size of the business. Bigger businesses sell at a higher multiple. With that said, if you're in that 10-year to exit or 5-year to exit, you should seriously consider doing acquisitions, because I just talked to a company who's in the $3 million EBITDA range, and they have an opportunity to buy a company at 3 to 3.5 times EBITDA. And if they purchase that business at 3.5 times, they're going to get at least 5 or 6 times for that business. So it's very accretive to their earnings and to their values. So that's what private equity companies do, is they buy a platform company, and then they go out and buy these smaller acquisitions. And then when they eventually sell that business, they're paying 5, 6, 7 times for the platform. They're buying things at 3, 4, 5 times. And when it comes time to sell, they're getting 7, 8, 9 times, because they've built this big company. So that's one of the key ingredients. For propane businesses, customer tank control, company-owned tanks is very important. Heating oil businesses, it's automatic delivery. That's one of the key things. I won't go through all of these. The new one that's on the list is number 20, COVID compliance. It's becoming an item. We've heard some horror stories about delivery departments being completely shut down because of COVID. Service departments, same thing. You get a bad reputation with your customers. It's very easy for customers to leave. They hear about it. I know we had a restaurant a couple towns away that they shut the restaurant as a result. My wife and I are very hesitant to even do takeout, from there, since they opened up. So just keep an eye out on your COVID compliance. It's important right now. Hopefully that'll go away, but that's where we are. These are value drivers that make the difference on what that multiple of your operating income is. Okay, I do want to talk about COVID because it's here now. These are some trends we're observing. Margins have been very good. As a matter of fact, when we saw margins in 18 and 19, we didn't know they were going to hold. But with the lower cost of fuel, we're seeing them strong again in 2020. When you have 2 or 3 years of good margins, that's a trend, and buyers are going to accept those margins, not saying it's a blip. Sometimes the price of fuel goes down $1 a gallon, the cost of fuel, I should say, and you get this blip up in the margins. And now we have some consistently high margins, which is great for value for people looking to exit. Usage, we usually weather adjust. We don't know how to COVID adjust. People are going to be working from home. They're going to be schooling from home. Setback thermostats are not going to be used as often. We are expecting this winter, like we saw this past fall, this past spring, we are expecting this fall and this winter to see increased usage. So, again, very difficult for a buyer. A buyer's got to look at it and say, how much is that the business staying steady, or how much is it COVID related? It's hard to tell. People are investing in their homes. We do work in the propane industry now, And we've been talking with a hearth company, and they're backed up on their installations into January. They said they've never seen anything like it. People didn't go on vacation. They're investing in their homes. They're buying those outdoor propane heaters so they could eat outside and maybe have guests over. We've done that ourselves. So that's one thing to look at. So gross profit's good. I mean, our industry is very fortunate. Some operating expenses have decreased. This remote office workforce, I've talked to some people who said, we're never going to reopen that office if you have multiple offices. We have found that, the customer portals, people are using them and getting used to them. They can look up their bill, they can make payments, they, can find information. We're finding that being great, a good effect of this pandemic. The lower fuel costs not only help with margins typically, but they also lower, there's several things that revolve around revenues. So lower fuel costs will reduce your truck fuel expense. It will also reduce your bad debt because your revenues are likely down because you're charging less for your fuel, even with a higher margin. They also reduce working capital, which, we have interest we're going to talk about also. So some operating expenses are definitely down. The things that are offsetting that a little bit are the tight labor pool. It's some particularly older service techs, drivers. They're rethinking with COVID around, that they might not want to work as long, or they don't want to put in the overtime, or they're concerned about being in people's homes. And we're seeing some people who have retired, and we have an older age base for our drivers and technicians in the industry. So there's a lot of overtime as well. COVID protocols, I mean, to do it right, it's going to cost you some money. So that is affecting a little bit on the operating expenses. Cash flow, we're seeing been very strong the last few years. This accelerated in bonus depreciation. You buy a vehicle or you do an acquisition, you can write off 100% of used vehicles. You can write off 100% of propane tanks, and you can go back, and if you have more of a write-off this year, you can go back to last year and refile your taxes and take it from last year. Check with your accounting professional, but that's our understanding. As well as carry it forward to the next year. That's going to be phased out, but right now it's 100%. I think next year it goes to 80% bonus depreciation. Lower interest rates. We're down like 2% from 2 years ago. That in itself has increased the value of businesses. People are refinancing. People are, to get a lower payment on any term loans that they have. People are using that money to do acquisitions. So that's been a big thing. Tax rates, 2 years ago, Marty Kirshner and I, Marty from Gray Gray, we did a presentation on the effects of the new tax laws. And the after-tax income to most businesses was up between 12 and 18%. We were hoping, in what we do, helping people sell their business, we were hoping to see that 12 to 18% increase in value of businesses. We didn't see that, but we saw people stretching higher than they normally would. And some of the reasons we didn't see it is people said, if there's a new administration, is that going to stay around? So, now there is likely a new administration, so that's going to be affected a little bit. So we still think it's pushing values up a little bit. A lot of cash out there from the PPP loans. Not exactly sure how that's going to be accounted for. I mean, it'll be accounted on a balance sheet as a loan, but we're still figuring out what happens on your P&L. How do you present your EBITDA? So that's kind of on an individual basis, but it definitely has brought cash into the market. So the acquisition environment, earnings are pushing values up right now. Interest rates are throwing off excess cash and pushing values up. Taxes are pushing values up, but that's probably going to change. And we're keeping an eye on the whole capital gains. Biden wanted to go to ordinary income. Currently, it's 23.8. Ordinary income right now, the top tax rate's 37. It's 13.2% higher tax when you sell your business. If that happens, we don't know what's happening completely yet with the government, but that's something to keep an eye on. We don't think it'll happen in 2021, but more than likely it's going to happen in the future. Depreciation is throwing off extra cash, as we talked about. PPP money is available, as we talked about. We do quite a bit of acquisitions. We do somewhere between 12 and 15 a year. Several in Connecticut this year. Broders. We just actually closed on my oil company, Marandola Fuel. Casey Energy purchased them. Quinoco, and we've had several in Connecticut this year. And our offers are up as a company 12%, the number of offers that we get. We were averaging over the last 4 or 5 years 5.2 offers per business. We're up to 5.8. That may not seem like a big difference, 5 to 6, but it's a trend. So we're seeing that. We're seeing EBITDA multiples absolutely up. They should be up higher, but at least a quarter time for a pure heating oil company. If you got propane, higher, at least 1 times for a bigger company, either dual fuel or propane. It's been very, very strong this year. It might get stronger, we don't know. It's still a great industry to stay in, but it's also, right now happens to be, there's a lot of buyers and a lot of sellers. People will ask me, is it a buyer's market? Is it a seller's market? The answer right now is yes, because there's a lot of advantages for a buyer, and there's some things for a seller looking to exit, particularly looking at taxes in the future, that have made it a very robust market. Cash is still king, and there's cash out there and available. People really have shied away from retained gallon deals, particularly with interest rates being so low, which is another reason that, if you're looking to exit in the next couple of years, this might be a good year to do that. Caution for buyers out there and for sellers, and that is banking. Banking is really taking a long time, and there's some concerns with PPP loans. The banks on the seller side, which is usually our client, we had a transaction earlier this year in Connecticut, and the buyer's bank said the seller had to put their PPP money in escrow. They couldn't keep it until they got loan forgiveness. So that money, I haven't checked with the owner recently, but last time I checked, it was still in escrow because they hadn't gotten their forgiveness yet on the loan. And then on the buy side, we had the same thing happen on the last transaction that we did. The buyer's bank said, you have PPP loan out. If we lend you more money to buy this company, your ratios are going to be off. So they said, they kind of agreed that you have to at least apply for it. We have to look at your application. It doesn't have to be forgiven. They originally wanted it forgiven before they would lend them more money to do the acquisition. Banks have been really, really difficult right now. And it's taking a lot longer. Transactions are taking longer with COVID. So just wanted to fill you in on those things. That's it for me. I'm always available for questions or emails. So I'm going to turn it back to Zach, who'll let you know. Sometimes it's not what you sell your company for, it's what you get to walk away with. And then what are you going to do with that money? Is it going to, sit in your savings account at 0.00001%? Or are you going to be able to live off those funds?